and welcome. I'm Kavita Thapliyal and we are celebrating National Nutrition Week on ET Now and on The Money Show. Today's edition is all about giving your portfolio the power of gold, fixed income and real estate. Now, Indians love gold, but when it comes to investments, there's still a lot to do in terms of literacy where investors need to understand the clear difference between gold for consumption and investments. Talking about fixed income, one thing's about safety and stability in the portfolio for sure, but then something, it's almost like having carbs in your thali of nutrition. But what are the other forms of fixed income instruments and what should be your exposure in these asset classes? We will get it all answered today on the show. Along with that, last but not the least, real estate, an asset class that we all aspire to own right when we get into the workforce, your dream house or your biggest investment. We will talk about this asset class's changing trends and the necessity to own your house and how does it lead to becoming an income generating avenue also. And we shall get into the details of all of this and let's begin the show. Today I have with me Abhishek Kabisen, Head of Fixed Income, Kotak Mutual Fund, G. Chandrasekhar, Commodity Expert and Pankaj Kapoor, Founder and MD, Liasis for us. Good evening and welcome to the show. So it's National Nutrition Week that's going on, and on the Money Show we are going to talk about nutritious dose through this asset classes that one might get in their financial portfolio. So let's talk about gold because that's shining the brightest. Chandrasekhar sir, what do you have to talk about the dose of nutrition that we get from this asset class in the financial portfolio and how important it is considering all favorable scenarios for gold which are emerging right now?
Absolutely important. There are many asset classes, starting with equities. You have bond, you have forex, you have real estate, but commodities and more specifically gold has emerged as an asset class, an important asset class over the last 25 years. Okay, and more often than not, investment in gold has given double-digit return. Yes, there are years when the returns have been single digit or even negative for that matter, but those are exceptional situations. But by and large, gold has given double-digit returns to investors. And my strong belief is every investor must have at least 10% of his investment in the form of gold. Within gold, there are various investment options. We'll come to that later, but gold, 10% of the allocation should be for gold in my view, primarily because it's a good hedge against inflation and it's actually also a safe haven asset. Central banks across the world are all buying and stocking gold like nobody's business. For example, the People's Bank of China, and of course many other central bankers. And demand for gold keeps rising, especially in emerging markets, populous countries like India, China, Indonesia, Turkey, etc., etc. Therefore, I think gold is a perennially glamorous investment for all of us, and it has not disappointed the investors. It's given a very, very good return, and therefore, I would think gold must become an integral part of every investor's investment portfolio. Minimum 10%, it could go to 12 or even 15%, and there are some people wanting to take it up to 20%, but that's individual appetite and individual choice. But I would think 10% is a benchmark.
Absolutely, and there are different ways to invest in gold. One can definitely look at gold ETFs. You can look at gold funds, sovereign gold bonds. Also, multi-asset allocation category, which is a very diverse category under mutual funds, where also you have exposure towards gold. So that benefit can be taken over there. We will discuss more about gold, but then let's also talk about fixed income because Abhishek, here also we have a very favorable scenario coming up, looking at the rate cut ahead. What is your analysis? And right now, considering the situation, do we have time to lock in money for maybe medium to long term? Looking at the rate cut scenario, should we be doing that right now?
Yeah, certainly. We have been talking about the scenario for some time now. Given the outlook on the macroeconomic factors, we believe time has come when we will see rate cuts coming in. and still there is good enough steam available in the rates where you can get some amount of upside. So if you have some money which can be locked up for more than 12 months or so, or maybe 24 months, you can definitely look to lock in for in something called duration funds at the current juncture.
Abhishek, talking about India story, talking about India rate cut story, what's the number that India will be comfortable with in terms of rate cut? In the US, we are definitely debating about 25 to 50 BPS, but then for India, what's the number according to you, or what should be the number according to you, Abhishek?
Uh, at the current setting, we believe over the cycle, we are likely to get around 50 basis point, but that's not it because interest rate largely move due to liquidity as well. So if you add liquidity impact, you can see an impact on interest rate of overall about 100 basis point in this cycle with the current setting. And as the situation emerges, it can change obviously.
Absolutely. And Pankaj, this will definitely give boost to all the home buyers because especially the ones who've been, going through higher EMIs, the interest rates over there have really peaked out. And we are also looking at a festive season, which is just beginning. And we are expecting, as per the data, the registration in few cities are at record highs. Is the trend likely to continue looking at the rate cut scenario and the overall optimistic sentiment across asset class, Pankaj, that we are witnessing? How much more do you think will factor in for real estate over here now?
I see it is going to be growing only. I don't see any decline coming by, although the prices has really improved over last 1 year or 1.5 year, but it hasn't really impacted the affordability. Still, affordabilities are still as good as which used to be in the period of 2004, 2005. If I do the parities between prices and affordability, and with the interest rates going down, I see the affordability will improve, which will also help boosting the sales. And I see it will do good to the segment which was actually seeing a declining trends of the affordable housing. Recently, the government has also actually in the last budget mentioned about the recontinuation of CLSS benefit to the affordable housing. So interest rate reduction along with the benefit under the CLSS schemes coming back, I think the affordable housing will see continuity of the growth. And once the affordable housing comes back, because in the last 1.5 year post-COVID, I see the market was majorly driven by luxury and ultra luxury segment, where the affordable and mid segment was actually taking a back seat. Now going forward, if the affordable and the mid segments coming back and adding to the pie, I see the growth will continue to be, and I see there is no retardation in new supply, whether it is smaller cities or large cities. So as the new supply continues, you see the aggregated volumes of sales will also be there. Along with this, we are also, since the affordability and prices have the parity, we are also seeing the prices are moderately improving. So it is bringing the investors component also back to the market. So we have a end user which are finding the houses affordable. We have the maximum supply ever produced in the real estate sector. We have prices going up, which is also bringing back the investors. So I see the growth story is likely to continue, and during the festive season, it will actually propel further.
So I was just looking up on a data, Pankaj, over here. So top 5 cities are actually Indore, Surat, Jaipur, Vadodara, and Nagpur. Is this trend likely to catch up and go deepen further towards tier 2 and tier 3 towns, or is this just the beginning? Not a single metro out here in the top 5 list.
So only the tier 2 cities, tier 1 cities, which is major metros, already have been doing good. So if you add the MMR, NCR, Pune, Hyderabad, Chennai, and all those things, they contribute 85%. This data only mentions about the top tier 2 cities, which are the smaller cities. And in that comparison, the Surat and Indore and Vadodara, they are doing good. And within these particular cities, we are also seeing the plotted development is doing better than the apartment market. So and one thing why we mentions about the tier 2 cities, because after the COVID, we saw the K-shaped recovery where the tier 1 cities actually showed a early recovery in the growth and with respect to the sales growth and the new launches growth. The tier 2 cities took the time, but in the last 2 quarters and 3 quarters, we are seeing the recovery in the smaller cities also. So this was actually mentions about the tier 2 cities. The tier 1 city is not part of this particular table.
Sure. All right, Abhishek, I'll come back to you again and let's talk about fixed income now. Since you've given us a strategy first, I also want to understand the kind of allocation. See, in a financial portfolio, you can experiment and you can have a lot of investment instruments. When we talk about the kind of ratio one might want to have in their portfolio, it basically depends on your financial goal, because we're talking about a financial portfolio where we are assuming it's for a longer time horizon. Now, in this perspective, according to you, is it time to maybe rebalance your portfolio, shift slightly more towards debt? Because see, even equity is on a high, right? And you really want to make the most out of your investments. What should be your exposure concentration now in equity and in debt?
It depends on what kind of volatility you can tolerate. So there is a concept of risk reward. So for example, let's say if you are getting a 10% return in fixed income and some around 11 or 12% equity, so debt clearly gets a favor. So from with that perspective, if we believe that the returns which are going to be delivered in the immediate future, let's say next 2 to 3 years from equity are going to be similar or slightly higher than that, then debt definitely gets a advantage over equity. Now it depends on individual's choice that if he has a extreme long-term investment horizon, then definitely since equity any which ways outperform, he can choose over equity. But given the volatility factor in which can create or which can create a differential between debt to equity quite a lot. So debt has to be on the higher side in the portfolio at this point in time.
Debt. Abhishek, within debt, if I want to understand the kind of strategy for a longer period horizon, what will be your favorite instrument in fixed income? And also, we haven't really touched upon the taxation benefits out here. Let's just talk about that also, because equity and debt, they both are separately taxed in terms of your holding period as well. How
Yeah.
can one look at it?
So I normally we recommend investors to choose investing through mutual funds only. Direct investing can become tricky as far as debt is concerned. So let me just give you perspective from the mutual fund side. So we will discuss the taxation part separately because that makes the overall argument bit tricky. But assuming you just need to choose something from the debt side, at this point in time, as we are the peak of the cycle and we look at interest rate cuts anywhere starting from October to December in India, and the Fed is likely to deliver rate cuts in September itself. So with that perspective, all long duration yield funds or dynamically managed debt funds are much suited for any investors who's looking to invest or allocate anything in debt. But there are investors who just want some short-term investment, then they can definitely choose anything between 1 to 3 year duration products such as short-term or index funds such as sectoral index funds which have come. So they can choose something around that segment as well. So it depends on particular choice. If you have an objective for short term, you can go for short. But just from a viewpoint of view, one should look at the long term funds such as gilt or dynamic bond funds.
All right. Chandrasekhar sir, I really want to discuss about sovereign gold bonds where we have not seen any new tranche coming after Feb.
Yes.
There are a lot of things going around about this particular investment for gold can be discontinued. We might not see, or maybe we might not see any more tranches coming for a very long period of time. So, what is your rationale behind Feb being the last tranche we saw in this year so far? And so then it leaves us with only gold ETF and gold funds and digital gold that we can buy in terms of investments in gold, right?
It's like this. You've seen 20% appreciation in gold prices since the beginning of this year for various reasons. Geopolitical tensions and central bank buying, and then you have the rate cut expectations, etc. But this kind of an escalation in price does not happen every year. This is number one. Number two, as far as gold is concerned, it's a non-interest yielding investment asset class. Okay, that is something we need to bear in mind. And therefore, and then within gold itself, you have opportunities to invest in physical gold, in ETF, in gold bond scheme, in derivatives, futures contracts, options, etc. Therefore, one can actually allocate up to 10% of one's investment into gold, not put everything in physical or in ETF, actually spread across various options that gold offered. Therefore, I would actually think the gold bond scheme was actually a good scheme. The investment was bearing at 2.5% per annum interest rate, and therefore, but I don't know what's going to be the future of the gold bond scheme. Many of these schemes that started 8 years ago are all coming up for redemption. Therefore, government will have to pay back that money with interest. And therefore, at this point of time, I am actually thinking because the world prices and Indian prices are at record levels, it is not advisable to buy at these rates because the further upside to the market will not be that great. Having said that, I'm actually expecting a small correction in gold prices, both internationally and in India. Gold prices could be down in the short term by $40-50 per ounce. That will create a buying opportunity for investors. And having bought that, they need to wait for at least 6 months and beyond. Because my own expectation is that in 2025, gold from the current levels has an upside potential of about at least $100 to $150 an ounce. That's the kind of appreciation that I expect. Currently, it's about $2,500. It could potentially go to $2,650 or even a little beyond. But much depends on the geopolitical situation and political uncertainties relating particularly to the US presidential election. I must also caution, because caution is important, that current prices of gold actually bear a war risk premium to the extent of $200. Assume a situation where tomorrow there is a ceasefire announcement say with Hamas or even Ukraine war, etc. That will create a big collapse in gold prices to the extent of $150 to $200. That risk we need to bear in mind. And therefore, investors should know when to enter the market and when to exit the market. And in my view, and I always say, entering the market is easy. You should know when to exit the market. And therefore, you've got to be glued to the market all the time to be able to exit and book your profit and not incur losses.
So, sir, do you think silver will also follow gold, or also being an industrial metal, it will
Yes.
have a separate movement? Yeah.
Absolutely. I think silver has much more volatility than gold. This
Sure.
year, again, going back to gold, we found 18 to 19% volatility. Last year, gold volatility was single digit, 9%. This year, it doubled for those reasons I mentioned earlier. Silver often outperforms gold. Silver is an industrial metal. and silver market, global silver market is actually in a 6,000 ton deficit. Okay, and of course, huge speculative capital is also entering this market. Therefore, I'm more bullish on silver than on gold, and I expect silver to cross dollars an ounce and possibly towards the end of next year go closer to $35 an ounce, and that will be a good investment.
All right, Pankaj, I also want to understand one thing, because when you talk about buying properties, there was a phase in between where we saw a lot of people going in for second homes, people buying property as investments. Do we still see that trend coming, or post-pandemic we've seen a change over there and people are primarily buying property for self-consumption? How can we strategize and make real estate and also, an income-generating avenue for your entire financial planning?
Yeah, in fact, if you see the 80% of the real estates by the residential, and residential is actually a low rental yield market, where the rental yield is between, most of the places 2.5% to 3.5%, which is there. And then we are coming from the phase from 2016 to 21, where the property prices remain stagnant and there were corrections. Only after the COVID, we have seen the property prices started going upward. So in terms of the demand distributions, I see now to some extent investor demand is coming back, rental yields have improved. So that is also bringing investor, and since the prices have started going up, which is bringing the confidence among the investors. So there are investors who started scouting back or started evaluating real estate market. And there are some of the developers who have done exceptionally well. They launched the projects which are the second homes property, far away locations, and the land plots and all those things, and they have seen a good amount of tractions in those particular projects. So there are, to some extent, investors participation is back in the market, but they are mostly a long-term investor. They're not really a flipper who are buying to really sell within a short period of time. Apart from that, the point which is there, that the second home decline was actually due to the ceiling of 2 lakhs, which earlier was not applicable for the people who were showing or setting off the rental income against the interest amount. So for the second home buyer, once the government really pegged it to the 2 lakhs limit, I think post that the investor participations really declined. And the post that, when the prices stopped growing, that's why the people were not participating much. But now, since prices have begun to grow and the outlook of the prices is also high, I'm not talking about the way Chandrasekhar ji is saying that there would be a short-term decline in the gold prices. I first time say there is no price correction risk in the real estate sector. So the price looks to be going up. And in that sense, you will see increasing interest of the investors coming back. And I see the people are choosing option of second home for a long-term gain, or as well as for the rental income point of view.
Do you want to help our viewers understand the recent taxation change that's been amended? Pankaj? Pankaj, can you hear me?
Kavita?
Yeah,
I
I can
can.
hear you now. Yeah.
So your question is,
Sure.
yeah,
The
your question.
taxation, yeah, capital gains, yeah, sure.
Capital gains, frankly speaking, I think the 20% deduction has been replaced to 12%, but later on the government also have clarified and says that the properties could be the people have a choice to choose the old regime as well as a new regime. So the confusion got removed. But otherwise, the taxations, when they proposed in the budget, where they said that instead of 20% with the indexations, the indexation will be removed and the capital gains will be applicable for 12%. I did my assessment. If assuming someone has bought a property in 2009 or 2000, and he is trying to sell a property now, during the period, a property like in a place like Worli, where the capital appreciation was at a meager annualized return of 2.4%. And if you remove the indexation, if you keep the indexation, then the notional losses used to be there. But otherwise, at 12.5%, the buyer was liable to pay 12.5% tax on the sale of the property, and which was actually adding to the boost to the investor, who actually saw very meager growth. Inflation adjusted, he was actually bearing the loss, and over and above, he was supposed to really pay the capital gains. So in that case, I think the government later on amended that particular rule and allowed the user to choose either of that. And I think I'm right in that particular sense. This is something which is there, and
Right.
it was needed. Otherwise, it was really impacting to the investor who purchased during the period of 2009 onward.
Sure.
Uh, uh,
Sure. All right. I think we've discussed on almost on a lot of aspects when it comes to investing in real estate, gold, and fixed income. Very crucial point of diversification that really one needs in their portfolio, and across asset classes, you really need to stay invested in order to diversify your risk and also enhance your returns. But then this is the end of the discussion for today. Thank you so much, Chandrasekhar sir, Pankaj, and Abhishek for being on the show and helping our viewers understand all the nitty-gritties across these asset classes. And it's time up on the show as well. I'm going to sign off, but then I'm going to leave our viewers with our WhatsApp number and email ID, because since we are talking about a lot of asset classes, you might have a lot of questions or your financial portfolio queries that you can send across on our WhatsApp number and email ID. And our viewers, our expert, can do your live financial planning on the show. Thank you so much for watching. Goodbye.